Your credit score. It's a three-digit number that holds immense power over your financial life. But to many, it feels like a complete mystery, a secret code held by banks and lenders that you can't possibly crack. This number, typically ranging from 300 to 850, dictates the loans you can get and the interest rates you'll pay. A higher score means better terms, saving you thousands of dollars over your lifetime. Want to buy a house, get a new car, or even get a premium rewards credit card? Your credit score is the gatekeeper, the first thing lenders look at to determine if you are a reliable borrower. But what if that gate is closed? A low score can lead to application denials, higher insurance premiums, and even difficulty renting an apartment. It's a number with real-world consequences that you can't afford to ignore. The good news is that it's not a secret formula. In fact, the calculation is surprisingly straightforward. It's based on just 5 key factors from your financial history, each with a different level of importance. Understanding these 5 factors is the first step to taking control. Once you know what lenders are looking for, you can start making simple, positive changes that will boost your score over time, opening up new opportunities. These categories are payment history, amounts owed, length of credit history, credit mix, and new credit. Each one tells a part of your financial story, and together, they create your final score. In this video, we'll break down exactly what each factor means, how much it impacts your score, and what you can do to improve in each area. Let's start with the most important piece of the puzzle. First up is payment history, the undisputed king of credit factors. It accounts for a massive 35% of your score. This factor answers the most basic question for lenders. Do you pay your bills on time? Every on-time payment you make on a credit card, car loan, or mortgage acts like a positive vote for your creditworthiness. Each one builds a track record of reliability, which is exactly what lenders want to see. Conversely, even one late payment can have a significant negative impact. A payment that is 30, 60, or 90 days late gets reported to the credit bureaus and can stain your report for up to 7 years. The more recent and more severe the lateness, the more damage it does to your score. More serious issues like collections, repossessions, or bankruptcies are even more detrimental and can take many years to recover from. Consistency is your greatest ally here. Setting up automatic payments for at least the minimum amount due is a foolproof way to ensure you never miss a deadline. This simple habit protects your score from accidental damage. Think of it like building a reputation. Each on-time payment is a promise kept, strengthening your financial character. A long history of reliability will far outweigh a single mistake from your distant past. If you do have a late payment on your record, don't despair. The impact of that single event will lessen over time, especially as you continue to stack up a new, positive history of consistent, on-time payments. The key takeaway is simple. Pay all your bills on time, every time. This one habit is the single most powerful action you can take to build and maintain an excellent credit score. It's the foundation of everything. Next, we have amounts owed, which makes up 30% of your score. This isn't just about how much debt you have, it's about how much of your available credit you are currently using. This concept is called your credit utilization ratio. It's calculated by dividing your total credit card balances by your total credit limits. Lenders use this to see if you are overextended or managing your debt well. For example, if you have a $10,000 limit and a $5,000 balance, your utilization is 50%. High utilization signals financial distress and can significantly lower your score, as it suggests you rely too heavily on debt. A good rule of thumb is to keep your overall utilization below 30%. An even better goal is to keep it below 10%. The lower your utilization, the better it is for your credit score. This applies to both individual cards and your total credit picture. Maxing out even one credit card can be a red flag to lenders, even if your other cards have zero balances. Balance is key across all accounts. Paying your balance in full every month is the best strategy. This ensures your utilization is reported as very low or zero, demonstrating excellent debt management skills. You don't need to carry a balance to build credit. One simple trick is to make payments before your statement closing date. Since lenders typically report your balance on that date, paying it down early means a lower utilization number gets sent to the credit bureaus. So the second major rule is to keep your balances low relative to your limits. This shows lenders you use credit responsibly and don't need to rely on it to make ends meet, making you a much more attractive borrower. Making up 15% of your score is the length of your credit history. Lenders prefer to see a long, established history of responsible credit management. Time is on your side with this factor. This factor considers several things, including the age of your oldest account, the age of your newest account, and the average age of all your accounts combined. A longer history provides more data on your borrowing behavior. Your oldest account acts as an anchor for your credit report. If you opened your first credit card at age 18 and have kept it open, that long-standing account demonstrates stability and a lengthy track record. The average age of your accounts is also crucial. Opening several new accounts in a short period can significantly lower this average, making your credit profile appear younger and therefore riskier to potential lenders. This is why a common piece of advice is to avoid closing your oldest credit cards, even if you don't use them often. Closing an old account can erase that positive history and lower the average age of your accounts. Instead of closing an old, unused card, it's often better to use it for a small, recurring purchase once every few months and pay it off immediately. This keeps the account active and the history intact. For young people just starting out, this factor can be a challenge. The best strategy is to begin building credit as early as possible, perhaps as an authorized user on a parent's card, to get the clock started. Ultimately, a long and positive credit history is built over years, not months. The key is to open accounts you'll keep for the long haul and think twice before closing your oldest lines of credit. Next, let's look at your credit mix, which accounts for about 10% of your score. While not as critical as the first few factors, it still plays a role in showing you're a well-rounded borrower. Lenders like to see that you can successfully manage different types of credit. The two main categories are revolving credit and installment loans. Having a healthy mix of both is generally seen as a positive. Revolving credit includes things like credit cards and lines of credit. You can borrow up to a certain limit and make variable payments. The balance can go up or down as you use it and pay it off. Installment loans are for a fixed amount with a fixed payment schedule. This includes mortgages, auto loans, student loans, and personal loans. You pay the same amount each month until the loan is paid off. Having a mix, such as a mortgage, a car loan, and a couple of credit cards, demonstrates that you can handle different payment structures and financial responsibilities, which reduces your perceived risk to lenders. However, this does not mean you should go out and open new types of accounts just for the sake of improving your mix. Applying for new credit can have a temporary negative impact, which we'll discuss next. This factor is more of a byproduct of a healthy financial life. As you go through life, you will naturally acquire different types of credit. The key is to manage all of them responsibly. So, don't stress about your credit mix too much. Focus on paying all your accounts on time and keeping balances low. A good mix will often develop naturally over time as your financial needs evolve. The final piece of the pie is new credit, which also makes up 10% of your score. This factor looks at how recently and how frequently you have applied for new lines of credit. Every time you formally apply for a loan or credit card, the lender performs a hard inquiry on your credit report. This is a record of their request to view your file for a lending decision. A single hard inquiry might cause a small temporary dip in your score, usually just a few points. It's a minor event and your score typically recovers within a few months, assuming you manage the new account well. However, opening several new accounts in a short period is a major red flag. It can signal to lenders that you are in financial trouble or are taking on more debt than you can handle. This is why it's wise to space out your credit applications. Avoid applying for a new store card, a car loan, and a personal loan all in the same month. Be strategic about when you seek new credit. It's important to distinguish between hard and soft inquiries. A soft inquiry, like when you check your own credit score or receive a pre-approved offer, does not affect your score at all. There is an exception for rate shopping. Multiple inquiries for a specific type of loan, like a mortgage or auto loan, within a short window, usually 45 days, are typically treated as a single inquiry to allow you to shop for the best rate. The takeaway here is to be mindful and deliberate when applying for new credit. Only apply for what you truly need and try to space out your applications to avoid appearing desperate for credit. Now that we know what goes into your score, let's bust some common myths. Misinformation can be just as harmful as a late payment, so it's crucial to separate fact from fiction and manage your credit wisely. Myth number 1, checking your own credit score will lower it. This is completely false. As we just learned, checking your own score through a credit monitoring service is a soft inquiry and has zero impact on your score. In fact, you should check your score and your full credit report regularly. This helps you track your progress and spot any errors or fraudulent activity before they can cause significant damage to your financial standing. Myth number 2, you need to carry a balance on your credit card to build credit. This is a persistent and costly myth. You do not need to pay interest to build a good credit score. Lenders simply want to see that you can use credit responsibly. Paying your bill in full every month demonstrates this perfectly while also saving you money on interest charges. A zero balance is a good thing. Myth number 3, your income, age, or marital status directly affects your credit score. This is untrue. Credit scoring models are legally not allowed to consider these demographic factors in their calculations. While lenders will consider your income when deciding to approve you for a loan to ensure you can afford the payments, your income itself is not a component of the credit score calculation. The score only reflects your credit history. By understanding these truths, you can focus your energy on the actions that truly matter, paying bills on time and keeping your debt levels low. These are the real keys to unlocking an excellent credit score. So, let's bring it all together. Your credit score isn't a mystery, it's a reflection of your habits. It's calculated using 5 key factors: payment history, amounts owed, credit length, credit mix, and new credit. While all 5 factors matter, your focus should be on the big 2, which together make up 65% of your score. If you can master these, you are well on your way to excellent credit. First, pay every single bill on time. Set up automatic payments, create calendar reminders, do whatever it takes to make this a non-negotiable habit. This is the single most important action for your financial health. Second, keep your credit card balances low. Aim for under 30% utilization, but the lower the better. Pay your balances in full whenever possible to show you manage debt effectively and avoid interest. Your first action step is to get a copy of your free credit report from the official sources. Review it carefully for any errors that could be unfairly dragging down your score and dispute them if necessary. Building great credit is a marathon, not a sprint. It's the result of small, consistent, positive actions over a long period of time. Don't get discouraged by a low score. See it as a starting point for improvement. By understanding how your score is actually calculated, you now have the knowledge and the power to take control. You can build a score that opens doors and helps you achieve your most important financial goals. Take these lessons, apply them consistently, and watch your financial future transform. You have the blueprint. Now it's time to build. Thanks for watching, and be sure to subscribe for more financial tips.